In this particular lecture, I share some of my theories and practical tools on trading psychology and in particular, managing your emotions as a trader. Warren Buffett, one of the most famous investors, most profitable investors of all time, said, don't expect to manage your money unless you can manage your emotions. And I think emotional control and management as a trader is the most important skill to have, because if you can't manage yourself, there's not a chance you'll be able to manage your trading plan and your money that you have to trade. So in this particular presentation, I go deep on the human psychology. I share some things you've probably never heard of before, and I give you a great insight into how your brain's wired and how it works. I also give you tools, tips, and tricks to be able to manage this to make more profitable and successful decisions as a trader. And if you find this useful, please share it with friends, like, comment, subscribe, all that type of stuff. But I know you guys will get a lot of value from this, so enjoy the presentation. Okay, and welcome to the Emotions Masterclass. Now, Warren Buffett is quite famous for saying, and I'm going to paraphrase here, something along the lines of, don't expect to manage your money unless you can manage your emotions. One of the greatest investors in the world knew the value in self-management, self-awareness, being able to understand what's going on inside you, inside your own head, and being able to manage the emotional volatilities. This particular masterclass, I'm going to share some of my theories that I've developed over the last 5 to 6 years in my own trading journey, in my own studies, in my own time working with traders as a performance coach through the education business, etc., etc. So there's going to be a lot of new insights that you guys and girls are going to draw from this, and I'm really excited to share this stuff with you. If this resonates with you, this is just the tip of the iceberg in terms of my emotions masterclasses that I share, that I have. The real juicy stuff goes week 5 through to week 10, 11, 12 in the 12-week challenge. So make sure you check that out if you resonate with this stuff. But let's get into it. The objective of this particular presentation is to educate on what emotions are. A very important key concept to not only trading mastery, but life mastery, being able to manage yourself. And also give you the tools and mental models to manage them. I'm not only going to show you what emotions are, but I'm going to show you how you can manage them effectively. And ultimately, in the context of trading, to help you make more money. Because I know a lot of you guys and girls are here watching, you want to get funded, you want to scale funding, you want to manage private capital, whatever it is, I'm going to show you how you can manage yourself to be able to execute, make better, more profitable decisions in the market, and ultimately make more money as a trader. Okay, so emotions 101. Your emotions are a feedback mechanism. They're not a bad thing. You know, like I'm going to say here, you should not seek to remove your emotions. You don't want to get rid of them. You should seek to understand them and learn how to interpret them. The body is amazing at giving feedback back to people. A lot of the symptoms we have are actually feedback mechanisms if we learn how to interpret them properly. Emotions are a very profound feedback from your psychology, making you aware of certain things, yet they're misinterpreted at times, and people try and repress their emotions, or people try and express their emotions, and they're missing the point. They're missing the point of your emotions are actually a feedback, making you aware of certain things, learn how to interpret them properly and manage them, and you can use them to your advantage. So I'm going to show you part of that in today's presentation. So an emotion is a feedback of an incomplete awareness, okay? Your emotions are a feedback mechanism making you aware that you have an incomplete awareness in a particular situation, okay? If we experience a loss in the markets, for example, which is neutral in actuality. In actuality, the market moves a certain direction. That movement is neutral. You're not judging it if you weren't involved in a particular position. But since we take a position and we take a loss on that position, what we label a loss, someone else you have to understand is on the other side of that trade. So when we lose, they win. The market moving from point to point is a neutral experience from an overview perspective in actuality. However, in that moment, we experience and label it a loss because we perceive more drawback than advantage in that moment. The trade tags us in and then hits our stop loss. And if we perceive more drawback than benefit in that particular moment, we're going to label that experience bad. We're going to label that experience a loss. And it's because in that moment we're aware of the drawbacks and unaware of the benefits, or aware of more drawbacks than we are benefits. So this here, the emotion, the resentment, the anger, whatever it is, the negative emotion in that moment is a feedback, giving you that feedback that you're aware of the drawbacks, unaware of the advantages. The actual experience before it enters into our perception is neutral. But it comes into our perception and we now compare it to subconsciously stored data. We perceive it as challenging our priorities and going counter to our expectations, and we label it bad. We label it a loss. And as a result of that perception, split seconds later, we have a change in biochemistry. The brain releases the pain substances, and we have a negative emotion. We have a painful experience. But that has everything to do with our perception. Okay, this is what I'm trying to share here. Initially, it comes from the perception of more disadvantage over advantage. We're going to elaborate on this more. I'm going to clarify this more throughout the presentation. Now, vice versa. If we experience what we're labeling a win, which is actually neutral in actuality, because from an overview perspective, the market moving from point to point, someone else is taking the other side of that trade. So for when we win, someone else loses. And if we experience a win and we perceive more positive than negative in that moment, we're going to label that experience good. We're going to label it pleasurable, and we're going to be happy. But that emotion, that positive emotion, is again a feedback mechanism trying to make you aware that you're aware of more advantages than you are disadvantages, or you're aware of the positives, unaware of the negatives in that particular moment. Okay? And bear with me, I'm going to show you how you can go back and you can make yourself aware of this stuff. It's very easy to prove to yourself. You just go have a look and you realize, you know what? It's true. There's both sides in that moment. I was just choosing to see one side because it supported my values or it challenged my values, and I had confirmation bias to block out what ran counter to that. But when I go back and actually have a look, it's true. They're both advantage and disadvantage in that moment. Okay? So the point here is that your emotions are the feedback, make you aware that you're only aware of half the equation. Okay, I really want you to get that, because that's a key point. Okay, now neutral market. I used the analogy before that heavy rainfall, let's say, the skies are pouring, heavy rainfall, whatever it is. If there's an individual who wants to get married that particular day and they've spent, months planning this wedding, and they've put on their best outfits, and they've made themselves look so pretty, and it's their perfect day. Heavy rainfall in that moment is going to be challenging that individual's priorities, what's most important to them in that particular point in time. And they're going to be pointing at that rain and they're going to say, this is the worst thing ever. Heavy rainfall is bad in this particular moment. Okay? But simultaneously, there's a farmer, maybe 100 kilometers away, whatever it is, just a form of an analogy, that's labeling that rainfall good because it's watering and bringing life to their crops. So heavy rainfall can be perceived as good, bad, or anything in between based on how it supports and challenges your values or priorities in that particular point in time. But the heavy rainfall itself isn't good, bad. It's our perception of the heavy rainfall, what we choose to label it based on how it supports and challenges us in that moment, and based on our subconsciously stored data of association of the past. So the heavy rainfall is neutral. It's neither good nor bad, it's just heavy rainfall, but we choose to interpret it in certain ways, okay? So there's a difference here between what's actually there in actuality and how we perceive things in our personal reality. And distinguishing between these two things is a key cornerstone to having a successful trader's mindset. There's a difference between what's actually there and how we perceive what's there. Okay, so for every winner, there's a loser in the market, and vice versa. It's all about your perspective. It's all about your perspective. It's all about how you perceive certain events in the market. And what I'm going to do is I'm going to bring up the markets now and actually show you this just as a form of analogy, just to really knock it into your head, that it's only when we take a stance in the market and have certain expectations that do we become victims of the market, of the circumstances of the market. So I'm going to bring up a chart now and just show you that, and just try and picture this very this particular principle in the context of the actual market. So I'm gonna bring that up. Okay, so let's say we brought a chart up here. It doesn't really matter what chart or whatever it is. It could be a currency pair, it could be a crypto, it could be a stock, it doesn't matter. What I want to show you here is that the market's going to move. The market's going to do what the market's going to do. Nobody really knows what's going to happen next, but the market's going to move. Now, first thing to say is that if we're looking back at this particular data, we don't necessarily judge it. We just say, okay, the market moved down at this particular point and it sold off pretty aggressively. The market was moving up here and it started to form some form of a reversal structure and then it sold off. Whatever, we don't judge it, okay? Now, it's really important to note that this movement in the market is what it is. It's like that heavy rainfall, it's just movement in the market. But it only becomes good or bad when we take a stance and when we have an expectation. So, for example, if we decided for whatever reason to buy at this particular point, let's say we decided to buy here, and we had our stop loss here for whatever reason, maybe this is what your rules say, maybe not, and we had a take profit or whatever here, doesn't really matter, but I just want to use this as an analogy. Let's say we got involved in the position here, and the market started to move. Now, if we had an expectation that, all right, I'm getting involved in the market here, it's going to go here, and my stop loss isn't going to get hit, we take a stance in the market. We have an expectation. Now, we now take a loss in the market as this particular price action moves, and we're labeling now this movement in the market as bad. We are choosing to interpret that data as bad because we've taken a loss. It goes counter to our expectations, challenges our priorities. We've compared it to subconsciously stored data of losing money, and we label that experience bad. The market isn't actually bad. That movement isn't bad, right? Because if we didn't have those things, if we didn't have those expectations, we didn't have that bias in the market, we'd just be seeing that as normal price movement and price action. So it's only when we take that stance, have those expectations, and have those expectations challenged, do we now label that experience bad, okay? Now you have to understand that if we bought that, we had to buy that from someone else, so someone else sold that, and guess what? When we're simultaneously labeling that experience bad, let's get rid of this now, someone's taken the other side of the position and is labeling that movement good because they're making money on it. But what I'm trying to communicate here is that that movement isn't good or bad, it's just movement in the markets. But if it supports our priorities and aligns with our expectations, we make money on it, we compare that to subconsciously stored data, which is pleasurable, we then label it good, we choose to label it good. So what I'm trying to communicate here is that the market and its movement is neither good nor bad, but it's when we narrowly perceive it through a small lens and have expectations, do we choose to label it good or bad? And we have emotions as a result, okay? So what I'm trying to communicate here is that the market's neutral, and it's wise to be neutral in the market so you can learn to adapt and evolve when you need to be, and you can learn to stick to your trading plan. And in a sense, just make the wisest, most profitable decisions as opposed to being run by your previous loss was a loss, or your previous trade was a loss. I'm fearful in the market, the previous win was a win. I'm elated in the market, which have consequences as well, okay? So hopefully that makes sense. Just want to communicate that the movement in the market is neither good nor bad. It's in our mind that we create the good or bads, okay? We have to understand that the price action itself is neutral, and then when it comes into our perception, it's at that moment of perception, when we perceive the movement in the markets, at that moment of perception, that do we then compare it to that subconsciously stored data and have our interpretation of the market? And that's where we start to judge it. Good, bad, really bad, and have those emotions as a result. Because our emotions are going to be a side effect of the ratio between good and bad, support and challenge that we perceive in the market. So if we perceive in that moment the neutral data and we compare it to subconsciously stored data in our mind, and we see 3 times more challenge than we do support in that moment, that's going to be a negative emotion, okay? So we have to distinguish between what's actually going on in the market and our interpretation or our perception of that. And it's only in our minds that we choose to make the market's movement good or bad, based on our expectations. This is really why I put the Bulletproof Your Mindset tool together, to help people ground their expectations before they get into positions, so they're going away from this particular trap. It's only, we label it good or bad when we have logged resentments or infatuations of past moments in the markets as traders. Hence why I put together week 5 in my 12-week challenge to help traders go back, address, and manage those particular experiences, so they're free to be present with the market now and make the wisest, most profitable decisions. Okay? So it's only in our mind that we label things good or bad, and our interpretation of the market is what leads to the emotions. Now, the problem: both winning and losing are a normal part of the trader's journey and the trader's edge. In an edge, you have to win and lose. Sometimes you're going to win, sometimes you're going to lose. But if you're emotional when you win, you'll go into pride, and you'll be elated and puffed up when you win and exaggerate your abilities, and then you'll start to project low quality setups into the market. You'll say, I'm invincible now, I know what's going on. You're gonna start to take shitty trades, and as a result, you're not gonna be sticking to your trading plan. You're gonna be projecting low quality trades that aren't even part of your trading plan. If you're emotional when you lose, you'll go into shame, you'll be resentful to the market, you'll be resentful to your own actions, and you'll be too scared to act when the market presents an opportunity. Again, you'll be not trading your plan because of fear. So if we don't learn to manage our emotions, we're going to be run by fear and greed, and as a result, we're going to be taken away from trading our trading plan, trading our process. Now you have to understand that you're gambling if you're not trading your trading plan, because it's only really when you execute on your plan is when you have an edge. So whenever we're in fear and greed, projecting low quality setups into the market, or too fearful to act when the market presents opportunity, we're gambling, we're not sticking to our plan. This is why it's so important to learn how to manage fear and greed. This is why I really put the 12-week challenge together, to help people do that so they can go back to sticking to their edge and sticking to their trading plan. So your emotions will stop you from executing on your edge, and it'll stop you from consistent profitability. The solution. Now, traders need to train themselves to see both sides of winning and losing. Right? They need to see that winning has drawbacks, losing has benefits. Not to make losing bad, or not to make losing good, not to make winning bad, but just to see them for what they are, just balanced events, just movement in the market. i.e. the benefits of losing and the drawbacks of winning, until the outcome is balanced. Now, why do you want the outcome to be balanced? You want the outcome to be balanced so you go back to your trading plan. If you win, you may puff yourself up and get elated by that, but you get yourself back to a state of equilibrium, so you go back to your trading plan. You don't project low quality setups. When you take a loss, initially you might be a little bit pissed, but you find the benefits, you ground yourself, you get back to equilibrium, so you can go back to trading your trading plan. Okay, so balancing yourself and managing your emotions is all about getting back to that state of equilibrium, so you can make the wisest, most objective, most congruent decision with your trading plan, which is ultimately what's going to help you execute on an edge, which is ultimately what's going to help you have consistent results in the future. So you want to, in a sense, transcend the judgment of the outcome on individual trades, so you can consistently execute on an edge, which is going to lead to consistent profitability over a large period of trades. The truth is that all events are neutral until we choose to judge them, compare them to previous experiences, and label them good or bad. It's only when it comes into our perception do we label it good or bad. So what I'm going to get each and every single one of you to do, like I did in my previous lectures, do this again. Go back to your most painful trade, the trade that was just most painful. And you want to go back to that moment of perception right before you took in a neutral event and you labeled it bad. Because when you go back to that moment, you're more likely to see the other side of the event. So go back to the moment of perception, and you want to ask yourself, how in that moment, and from that moment until today, was that particular trade or that action that led to that particular trade that I'm judging, how is that actually a benefit to you? How did that serve you as a trader? How did that make you a better trader or a better human being? How did that help you refine your processes? What did you learn? What did you gain from that experience? That's positive. And you want to start to see the other side of that experience. So some classical examples, some classical benefits of losses or painful losses in the market. are things like it grounds you and it makes you accountable to continue to learn. Because a lot of times what we find is that it's traders that are puffed up and think they know it, that get humbled in the market. They take painful losses. So losing is a way to keep you in check and to keep you grounded, keep you open, keep you teachable, keep you realizing that there's always something else to learn. You always have to listen to the market. You always have to be open and teachable. Great. How else was it a benefit to you? You could see potentially that you made refinements to your plan. You know, maybe you went back and you refined or changed things up, or you refined your risk model, or you refined your entries slightly. Maybe you went off and continued to study and learn about yourself and your psychology, right? Maybe you started watching my videos or other people's videos that help on trading psychology. So the quality question to be asking in this moment is, how is it a benefit to you? How is it a benefit? And go back to the moment and ask yourself, how is it a benefit to you, until you see just as many benefits as you do drawbacks in that moment. And you see the event for what it actually is, not for your skewed interpretation because of the subconscious data and because of confirmation bias. Okay? And the moment you see benefit equals drawback in that moment, what starts to happen is you don't label that event bad anymore. You don't label it good. You see that that event has both advantage and disadvantage, and you transcend the judgment on that. And the more of those you do from the past, the most painful experiences you had as a trader, you start to transcend the actual judgment on losing and winning. And it gets you more process-based. Now when you go to a particular trade, you're not worried about winning and losing, you're worried about sticking to your trading plan, irrespective of what the outcome is. Same in reverse. Go back to your most pleasurable wins, and how was that a drawback to you in that moment? And from that moment until today. Okay, did winning maybe puff you up, and now you think you know it? You stop learning, you stop growing, you stop educating yourself. As you become complacent with the processes, with the routines, you start projecting low quality setups. Go back to the most pleasurable wins. Find the action you're doing that's leading to the trade, and how is that a drawback to you in that moment and from that moment until today? That's the quality question you want to be asking to ground yourself and get back to process-based decisions and to balance out and neutralize the emotional charge in that moment. Okay? You want to train yourself to see both sides of an event. Because the emotion is a feedback mechanism making you aware that you're only seeing one side of the event, the moment you make yourself consciously aware of the other side, the emotion is no longer there. You're not judging that event as bad and having resentment, having the emotion towards it. You see the event for what it actually is. And your interpretation of that event changes, and you're no longer emotional towards it. You're, in a sense, grateful for it, and you wouldn't want to change it because you see it was exactly what you needed in that particular moment. So training yourself to see both sides of an event helps you clear the emotional baggage in that moment. It frees you up to be present with the market, make process-based decisions, and make the most profitable decision in that particular moment. This will allow you to transcend the judgment on individual trades. This will allow you to be present with the market, and this will allow you to relentlessly execute on your edge, which will lead to consistent profitability. Okay? Through emotions that take you away from consistent profitability. Now, this here was just a small tip of the iceberg for my emotions masterclass that I cover in the 12-week challenge. If you found this insightful, first and foremost, I encourage you to get the Bulletproof Your Mindset tool that will help bring up that awareness in the moment before you take trades. And then check out the 12-week challenge. That will be a mind blower in terms of the things you'll learn and be able to actually apply into your trading with tools, with everything you need to actually get the brain change to start thinking like a professional trader.